buy, sell, ETF, advisory fees. There's a lot to know about the world of investing, including, and this is true, where you get your information from. I'm a CPA who's not trying to sell you anything. So let's get some knowledge and dispel some myths. In this video, the first in a series, we'll discuss some of the fundamentals on investing. Welcome to Investing 101. Hello to all you financial people out there, and welcome to Just the Tax. This is my little channel about spreading the good word of financial literacy, so it's more than just the tax. Quick shout out to all the folks at the Collegiate Financial Management Association's University of Maryland College Park chapter. Go Terps! I'm making these vids because this is stuff that I wish someone would have told me back when I was first starting out. Today we're going to talk about investing fundamentals. Let's get started. The first and most important thing is know thyself. Ask yourself these questions. Number one, what is the purpose of this money? Is it saving for a house, retirement, college, a vacation, or asset acquisition?
Don't you know the first rule of acquisition?
Number two, what is the amount of time for when you'll need these funds back out of the market? How much time do you have? Markets go up, markets go down. If you need that money sooner, you probably want to be less in things that are less volatile. Number three, do you lose your lunch on roller coasters? In other words, can you handle the volatility of the market? This is very important. There's no right or wrong answer to this. The answer that's correct is the one that's right for you. Never assume anything on this stuff. Take the time for introspection on this. Let's talk about timing for a second. Understand that, like chapters in a book, there are phases of life from a financial point of view here. In your 20s and 30s, it's all about asset acquisition. In your 50s, it's college years for your kids. In your 60s, it's supporting your elderly parents. In your 70s, it's your own retirement. Now, obviously, everyone's situation will be different. Some people will be supporting their kids and parents at the same time, and we call this the sandwich generation. Also, there's a lot of detail in each one of these things. Each one of these could be its own hours-long video. So for this time, we're going to stay focused on investing fundamentals, but just be aware that this exists. Before continuing, here's a list of books for further reading. First book is Simple Wealth, Inevitable Wealth by a guy named Nick Murray. The TLDR for that one is Optimism is the Only Realism. Meaning that, according to Murray, we need to invest in the market over the long haul. The next book is The Automatic Millionaire by David Bach. And the TLDR for that one is Make It a Habit. He's kind of like a set it and forget it. Now, I kind of disagree with the forget it part. You can't totally forget it, but I agree with the set it and make it a habit part. Now, I don't get any sponsorship from these guys, but I found their books helpful, and hopefully you will too. Moving beyond the basics, let's talk about the three-legged stool approach. The first leg of this stool is called a diversified portfolio, and this is what we're all very familiar with: stocks, bonds, mutual funds. Basically, it gives you exposure to the market. So you get that, you do get the volatility, but that volatility is what allows your assets to grow over time. The next leg of that stool is non-traded assets, things like rental property. This gives you other investment benefits like income streams, but without the volatility of the market. And then the third leg of that stool is insurance and complex products. And that's basically protects what you got. Now, that's a very complicated thing. That's usually the last thing. So people start out with the diversified portfolio, and then they'll add non-traded assets, and then the insurance and complex products comes later. For right now, I just want you to know that they exist, and this is the mindset that you have. So I'm giving you where you're at today, your point A, and then stops you're going to make along your investing journey over time. Okay, let's talk about types of investments, things you can invest in. First, we're going to define what an investment is. In this situation, or in this context, an investment is an asset, something that you can acquire that generates some type of income or gain, whether it's interest or rents or royalty or dividends, and then it should hopefully appreciate in value over time. Think of these things like chess pieces. They all have their pros and cons, and they're indicated at specific times. That you use them for certain purposes. So the first one, most common thing, is stocks. Next one is bonds. So stocks is when you own a share of a company, a piece of a company. A bond is when you make a loan to a company, you have to pay you back with interest. And then there's mutual funds, which allows people to put whatever money they can invest into a large amount of stocks or bonds. And you can get mutual funds in all different sectors and industries and strategies. And then there's ETFs. Those are exchange traded funds. And REITs, which is real estate investment trusts. And that's a way to own rental property without the hassle of actually being a landlord. Then there's non-traded investments and annuities and insurance products like we talked about previously. And then the fun stuff, commodities and currencies, like as indicated in that wonderful movie, Trading Places, funny movie. And then, of course, there's rental property. What's not on that list? The house you live in and the car you drive. These are not assets, they are expenses. Why? Because they don't generate any income. Okay, now let's talk about the mechanics of trading. First thing you got to do is open an account with a brokerage company, and you want to watch out for the fees. Now, when I first started trading, fees were like $15 to get in and $15 to get out. It was very high. Now there's so much more competition that the fees are reasonable, but you got to check what they're saying and what the fine print is, make sure that you feel comfortable with them. Also want to check their history. Are there complaints against them with the SEC or FINRA? Are they duly licensed? Make sure you trust them. Okay, so once you've done that, you've got your account, then you want to learn about order types. So the easy ones are buy and sell, obviously, but you can then buy at the market or set a limit, or sell at the markets or sell at a limit. So what that means is, let's say you want to buy a particular stock, and I'm not going to mention specific stocks in this video. This is about fundamentals, not recommendations. So let's say we buy at the market, right? So that's let's say it's trading at $9 and it goes up to $10, and somewhere in the between, your order will get fulfilled. So you could get that stock at, say, $9.50, whatever. That's buying at the market. Or if you say the market is opened at 9, I want to buy when it hits 9.25. So if the market doesn't quite get to $9.25, you won't actually get that order executed by the broker. And then, of course, selling at the market or selling at the limit. Next thing we want to learn about is setting a stop loss. So let's say you're buying a stock at $10 and you're concerned that if the market moves against you and the stock price drops, say to $9, you would tell your broker, hey, I'm buying at 10. If the market drops to 9, I want you to sell it, and you're capping your loss. It's called a stop loss. Then there's going long versus going short. So going long, sometimes called being bullish, it basically means you think that the price of something you're going to invest in is going to increase over time, or the value will increase over time. It'll grow. And then going short is the opposite, or sometimes called being bearish. That's where you think prices will decrease or value will decrease. One very important thing is never do a naked short. Now get your mind out of the gutter here. What I mean by that is, let's say you're thinking that the value of something is going to decrease over time. It's at $10, you're shorting it, you think it's going to go down, and instead the market moves against you and it just goes up and up and up. If you do that, you could lose everything before you know it. It can happen very quickly. So you want to set a stop loss above that. So if you think that something's going to go down, it's $10, you think it's going to go down to 9, and instead it goes up to 11, you would set a stop loss above that at 11 to at least limit your exposure. Very important. Another thing to be aware of is limit moves. That's where the volatility or volume can be so quick that the people that run the market will just suspend trading for a given time. The last little mechanic that we'll talk about here is buy low, sell high. Or you can also sell high and buy low. That's where you're shorting. So buy low, sell high is where you're going long, and sell high, buying low is where you're going short. Next most important thing is have a plan. Everything in your portfolio, anything you invest in, you must have a reason. It must justify its presence in your portfolio. You must have a plan. You need to set your exit strategy before you invest in anything. Next most important warning is don't ever try to time the market. There's an old saying that the market can stay irrational longer than you can stay solvent, and it is true. Here's a story when Time Magazine ran a cover said, "Why we're gaga about real estate." And I remember seeing that thinking, oh my gosh, there's going to be a huge drop in the real estate market. And sure enough, a few months later, there was. This was back in 2005, 2006. I just remember seeing it. It just stuck with me. And so where is this coming from? Well, there's this old saw, I don't know, robber baron from the Gilded Age said that he knew it was time to get out when the shoe shine kid was giving him hot tips on what stock to buy. And then then there was the Great Depression. So what does all this have in common? Beware of your ego. Have a plan and be boring about it. If you want excitement, go do like extreme sports or ride your bike or take a hike or I don't know, do something. You should not get too much excitement from your investing. You should get happiness from it, but not excitement. A lot of times people compare, oh, I got this and I got that, and it's like an ego thing. That's not how you want to invest. That's emotion. That's ego. Get that out of your portfolio. The next most important thing, if you get nothing else from this video, retirement money is sacred. Don't ever be aggressive with retirement money. When I say aggressive, I mean putting your money in things that aren't well regulated, aren't high traded. You want to be careful with what you put with your retirement money. The next thing is don't ever put real estate in an IRA. Now, that's a topic for its own video, but I have to combat this. Don't ever put real estate in an IRA. Summing all this up, invest in what you're comfortable with, interested in, and knowledgeable about. Now we got to talk about some cold hard truths. The first thing is a little context. There's this thing called fundamentals trading versus technical trading. So this is how you pick your stocks and bonds and whatever you're going to invest in. So fundamentals, that looks at all the financial metrics of a company. Days turnover and accounts receivable, executive compensation, P to E ratios, debt to equity ratios, like all that stuff, right? Then there's technical trading, which basically analyzes the price charts over time and it looks for patterns in these lines. And yes, it does seem like reading the tea leaves, but there is something to it, believe it or not. Now, retail investors, very important, you need to have at least $400,000 invested to truly be able to get diversification into your portfolio if you're investing in individual stocks. Until that point, which is for most of us, mutual funds and technical trading are your thing, mainly mutual funds. Having said that, we don't invest in a vacuum. It's just there's only so much time that you can spend on this stuff. So where are you going to put your priorities? Are you going to get into the minutia of a given stock's auditor's report, or are you going to just take some high-level fundamentals and then look at the charts and see where the prices are and then get in according to a strategy? Next thing is, when are you getting out of that stock? There's another sort of saying that we have, and that's leave something for the next guy. Don't try and get every single penny. Remember, have your exit strategy before you get in. I'm going to get in at this price. I'm going to get out at that price. It doesn't matter if it keeps going up, you're out. And you have to be very strict with yourself on that. The next thing to know is ETFs, exchange traded funds. They're not fully automated. There's always a human involved. So some people are like, oh, I'm just going to put it in some ETFs and therefore the fees are lower and I'm not going to get, taken advantage of by some advisor out there. The reality is, like chess, ETFs are indicated in certain situations and not indicated in certain other situations. You have to be careful. Always have your plan, have your strategy, know why those things are in your portfolio. The next thing is, you're not going to win every single trade, but you want to try and be consistent. As long as you're winning more than half the time, ultimately over the long haul, you'll acquire wealth. There's no science to this. This is the truth. It's all some combination of fear and greed, and it comes in cycles. So you want to be greedy when others are fearful, and you want to be fearful when others are greedy, generally speaking. And it's easier said than done. So how can you get started now? First thing is commit to learning. Read books and articles from trusted sources. Avoid get-rich-quick schemes like we talked about. If it sounds too good to be true, it is. The next thing is, and this is really cool actually, you can practice paper trading. So get everything as if you're going to execute a trade. Before you're putting actual money down, you can actually practice and build confidence and comfort and experience. The next thing is you want to build good habits. You want to adopt the right mindset. You want to commit to learning, get your emotions and ego out of the equation, and just have your strategy and stick with it. This is very important. Before you actually start investing, you want to make sure you have some money set aside in a rainy day fund. So every paycheck, you just put money away in a savings account, not in the market. That's just there in case something bad happens. And then also you want to commit to funding your retirement plan, at least to the point where you get the company match. And then once you've done those two things, you have your rainy day fund, your retirement savings, then you can start investing. But never invest with your rent money. So recapping all this, you want to make sure that you got your retirement money, your rainy day funds set aside and set up, and that you're not investing with money that would hurt you if you were to lose it, right? So as long as you've got that, then while you're learning, you can do your paper trading, and before you know it, you'll be in the market and on your way to building your wealth. And that's awesome. All right, my fellow financial people, thank you for watching this video. Please like, share, and subscribe. And in the comments below, post some requests for topics you'd like me to cover in future videos. In the meantime, may your profits be high, your taxes low, and I'll see you next time back at Just the Tax.